of Brexit. I'm Paul Darlow, and I will be chairing today's session, and I'm joined by two colleagues. Firstly, by Ben Gold, the head of our investment team in Leeds, and also by Hugh Creasy, a senior scheme actuary, also based in our Leeds office. Now, last Friday it was announced that the population of the UK had voted to leave the European Union. Since then, we've already seen the Prime Minister resign, the majority of the shadow cabinet resign, a vote of no confidence in the Labour Party leader, renewed calls for a second referendum on Scottish independence, and even calls for a vote on whether Northern Ireland should join with the Republic. It appears that the UK government is in no rush to begin the process of formally withdrawing from the EU, which means that what happens next, frankly, is uncertain and likely to remain so for a number of months, if not years. So in today's webinar, we'll look at what this uncertainty means for UK defined benefit pension schemes. We'll start by summarising changes in financial markets since the results of the vote were announced, before then looking at what those changes mean for pension scheme deficits. We'll then look at how financial markets might develop in the coming months and what those future potential changes could mean for deficits. We will then look at the question of employer covenant and what pension schemes can be doing to protect themselves and their members. Now, before we begin, just a couple of quick points of housekeeping. Firstly, this webinar is likely to last 40 minutes. And it is being recorded so that you and your colleagues will be able to refer to it at a later date. And a copy of these slides will also be made available to you afterwards. And secondly, if you'd like to ask a question as we go through, please do so by typing your question into the Q&A box that appears on the right-hand side of your screen. And time permitting, we'll take some questions at the end. So without further ado, I'll hand over to Ben to look at how financial markets have reacted to the vote.
Thanks, Paul. To start with, let's provide some context and remind ourselves that the UK equity market rallied by 6.5% in the week leading up to the vote. Despite numerous opinion polls throughout June suggesting the result would be close, markets clearly felt confident the outcome of the referendum would be a vote in favour of the UK staying in the EU. As such, the realisation that the vote was in favour of leaving the EU was a shock. This has resulted in significant movement and volatility in most financial markets since the results of the vote were announced. Before looking at some of the key movements in detail, I thought it would be helpful to firstly present an overall view of what we've seen. The pound has weakened very significantly against most currencies. Between the vote and Tuesday, it was down 10% against the dollar and 7% against the euro. Equity markets around the world initially performed poorly. In the UK, the FTSE 100 was down 3% at the close on Tuesday, but recovered this yesterday. And the FTSE 250, with its much higher exposure to companies with UK earnings, was down 8% at yesterday's close. And it's not just UK equity markets that have reacted negatively to the news. Global equities, excluding the UK, are also down. Gilt yields are substantially down. Indeed, they've reached their lowest ever level as investors have sought safe haven investments and expectations for future interest rate levels have changed. And lastly, the expectation for UK inflation over the next few years is slightly up, although it's too early to say what the longer-term impact may be, as we discuss further shortly. We'll look later at exactly what impact these movements have had on the financial position of a typical UK pension scheme. But unfortunately, nearly every single one of these movements is bad news for most, with the exception being the weakening of sterling if you have unhedged overseas currency exposure in your portfolio. So let's look now at each of these main market indicators in a bit more detail. We've seen the pound plummet in the past week, especially against the dollar. Whilst £1 would have bought you $1.48 on Thursday, at the end of Tuesday it would only buy you $1.33. Indeed, Monday saw a 31-year low. Whilst there have been significant falls against the euro, these are somewhat less than the falls seen against the dollar. This reflects some weakness in the euro amidst fears of what the impact of Brexit will be on Europe. Now, a weakened pound could have consequences that directly impact on pension schemes. Sponsor covenant could be impacted depending on where revenues are generated, where costs are incurred, and whether currency exposures are hedged. Imports become more expensive, and as a net importer, this could lead to higher expected and actual inflation levels in the UK. This in turn could increase schemes' liability valuations. And scheme asset values could be affected in either direction depending on their sensitivity to inflation expectations. Moving on to equities, I think it's interesting that whilst we've seen equity market falls, the magnitude of these falls are less than many feared. In the UK, losses since the vote were around 4.5% at the close on Tuesday and around 1.5% by yesterday's close, which has simply reversed the gains seen over the week before the vote. Equity market losses have been a little greater in Europe, at around 11% at Tuesday's close, probably reflecting fears over what the Brexit vote will mean for the EU. The US has fared relatively well, with losses at around 4%. Now, equity market falls are clearly negative for pension schemes, but in the longer-term context, falls at this level are fairly commonplace. It's also worth touching on volatility as well. Higher volatility tends to be associated with falling equity markets, and so is typically bad news for pension schemes. Volatility has increased since Thursday's vote. Volatility immediately rose by around 50%, but has now fallen back to be less than 10% higher. Current volatility levels are well within the normal range seen in recent years and well below the levels seen at the height of the credit crisis. This is perhaps a reminder that as yet we have no real idea what the impact of last Thursday's vote will be. After the initial shock, we may quickly get back to business as usual. That said, with so much uncertainty over the impact of Brexit, not just economically, but also politically and socially, expect volatility levels to themselves be volatile. Now, one of the unsurprising consequences of the shock and uncertainty felt after Thursday's vote is an increased demand for safe haven assets. This has led to a substantial fall in gilt yields. We've seen longer-dated nominal gilt yields fall by 38 basis points up to Tuesday and another 4 basis points yesterday. Similarly, we've seen longer-dated real gilt yields fall by around 35 basis points. The real yield on the over 5-year index-linked gilt index is now at minus 1.35%, and this is the lowest level we've ever seen. Since lower gilt yields lead to a higher value being placed on pension scheme liabilities, this is definitely bad news for most schemes. The more hedged you are, the lesser the impact, but most schemes will likely have felt some pain. Hugh will explore this further in a moment. For those of you that utilise leveraged LDI, these falls in yields correspond to an increase in the value of your LDI portfolio. This in turn will have reduced leverage levels. As such, collateral calls are less likely, which is welcome whilst volatility is higher. Finally, inflation expectations haven't changed dramatically on the back of the Brexit vote. The expectation is that inflation will be a little higher over the next few years, but lower thereafter. The longer-term impact is somewhat uncertain and will depend on various economic expectations, including the relative value of the pound and whether the economy will grow or shrink. I'll now pass over to Hugh to talk you through what these changes in financial conditions have meant for pension scheme deficits.
Thank you, Ben. To start with, I'm going to look at the financial outcomes using the market data that Ben's just been through. That will put the effects into context before we turn to looking at the interesting questions, how to interpret those changes and what actions to take. The funding deficit in a pension scheme is of course equal to the target reserve needed to cover the scheme's liabilities, less its assets. I'll start by taking each of the liabilities and the assets in turn. So, pension scheme liabilities have been affected in two main ways by the volatility that we've seen over this past week. The first effect is down to the change in gilt yields. Scheme liabilities are calculated by projecting the future cash payments to members and then discounting them to come up with a target amount we seek to hold now. That discount is simply an allowance to reflect investment returns we're budgeting to earn between now and the point the member is paid. The rate used to budget for future investment growth generally uses the gilt yield as a foundation stone, with a fixed margin on top. So, gilt yield falling is then equivalent to saying there is now a lower overall budget for future investment returns. Lower future investment income means you need to set a higher target fund now, and that is why the liabilities go up. As Ben just said, we've seen gilt yields drop dramatically over the past week, and this has increased funding levels, liabilities, significantly, and I'll show some examples shortly. The second main factor affecting the liabilities is the change in expectations for future inflation. Now, the link with the liabilities is more transparent here, and as Ben's just demonstrated, the markets expect UK inflation to be slightly higher in future than they did before the vote. This means that pension schemes will be budgeting for higher levels of pension than they previously expected, which means that the liabilities have again increased. So far, the effect is very modest, but Ben touched on the potential for rates to change, particularly in the context of the fall in sterling. Looking at the assets, most pension schemes will have held some of their assets in equities or other return-seeking assets, and these are likely to have fallen over the last week, albeit that the FTSE 100, as Ben was saying, has started to recover to pre-existing levels. Matching assets will have done well, and so the overall effect on the deficit is going to depend heavily on exactly how the particular scheme is invested. The key question is how much does the investment strategy hedge the value of the liabilities? Now, to bring all this to life, we'll now look at three illustrative pension schemes and see how they've been affected. Before the vote, each of these pension schemes had liabilities of £100 million. All of the schemes had assets of £80 million, and so they all had a deficit of £20 million before the vote. The only difference between the schemes is in their investment strategy. Pension Scheme 1 used liability-driven investment, leveraged liability-driven investment, to match £80 million of its liabilities. Through using that leverage, it simply invested £40 million of scheme assets in LDI to protect the existing scheme funding against changes in gilt yields and inflation expectations. That scheme invested the other £40 million in growth assets, which for simplicity we'll just say are direct equity funds. Pension Scheme 2 took a very similar but more traditional approach. It similarly invested around £40 million of the fund in matching assets, but these were simply in gilts and didn't use liability-driven investment. It invested the other £40 million in equities just like Scheme 1. Pension Scheme 3 was following a more aggressive strategy, investing just £10 million in gilts and the other £70 million in equities. So, what has happened to the deficit in these three example schemes over the last week? In each scheme, the liabilities have increased owing to the fall in gilt yields and increases in inflation expectations. Liabilities have increased from 100 million to a shade over 110 million. That's an increase of £10 million in a week. This is the big story for pension scheme finances so far. It's the point I fear that those who aren't close to pensions will miss when they see headlines about the FTSE being back to 6,300. As Ben said, those gilt yields have dropped and stayed low. Now, that liability increase has hit all three schemes, but this is where the differences in investment strategy create very different fortunes. Pension Scheme 1 hedged 80% of the movement in liabilities. Main story for Scheme 1 is that those matching assets have grown by just over £8 million. The scheme lost around £2 million on the equity funds, so the assets as a whole have grown by just over £6 million. Deficit in this scheme has therefore increased by just £4 million. Pension Scheme number 2 didn't leverage to hedge quite so much of the liability movement. Its matching assets have only gone up by half as much, that's by just over £4 million. The other changes are exactly the same as Scheme number 1, so Scheme number 2's deficit has grown by just over £8 million in a week. The real damage, though, of course, is Scheme 3 with such a low degree of hedging. Here the matching assets only picked up £1 million, and the large equity investment lost £3.5. Net effect an increase in deficit of around £13 million, and you can see how much of that is picked up through the liability shift. So, now that we've seen some context for the mathematical effects when measured yesterday, let's take a step back and look at the wider picture. Ben?
So, the figures we've just talked through are, of course, just a snapshot at a particular point in time. Perhaps of more relevance is how financial conditions might evolve in the coming months and years, and what that might mean for the future direction of pension scheme deficits. To say that this is uncertain is frankly a rather dramatic understatement. Today, we don't know for certain that the UK will definitely leave the EU, since a referendum was a non-binding advisory vote. The government could ultimately decide to ignore it. Assuming the government doesn't do so, however, it's not known when the process of leaving the EU will commence, nor when it will be finalised. It's not clear what sort of trade deal will be negotiated with the EU or elsewhere, nor when that will become effective. It's not clear what companies will do in the intervening period. Until the UK actually leaves the EU, trade with the EU could continue as normal, but in the face of uncertainty, it seems likely that many companies who import or export goods or who provide services outside the UK will look to develop contingency plans rather than waiting until we do actually leave. It's also not clear whether the vote to leave will lead to any other EU countries calling similar referendums. Certainly there have been calls for some European political parties to give their citizens a similar opportunity. To help make some sense of this uncertainty, we have developed 3 scenarios, each of which we think are plausible. These are looking over a medium time horizon from now, something like 3 years forward. The first scenario on the left-hand side of the screen is based on Brexit ultimately leading to the breakup of the EU as we know it, perhaps triggered by renewed concerns over Greece or Italy, or perhaps through a number of other EU countries voting to leave the EU. Under this scenario, we think it plausible that gilt yields could fall a further 0.5%. Inflation could increase by a further 2%, and equity markets could lose another 25%. This scenario would clearly be very detrimental to pension scheme finances. We'll look at that shortly. The second scenario, shown in the middle of the screen, assumes that the current fears regarding the possible negative impact of Brexit on the UK and indeed the EU are somewhat eased. Whilst Brexit may be a little negative for the UK, it's not expected to have a significant long-term global impact. In this scenario, we think it credible that gilt yields could drop by a further 0.25%. Inflation expectations could increase by around 0.5%, and return-seeking assets could drop by a further 5%. This scenario would be detrimental for the financial position of pension schemes, but much less so than the previous scenario. The third scenario, shown on the right-hand side of the screen, assumes that Brexit has a minimal impact on the EU or globally, and that the UK economy is invigorated as domestic opportunities become more global. In this scenario, we think it plausible for gilt yields to rise by 0.5%, with equities gaining 20%. To be clear, we're not saying that any of these scenarios are worst case or best case, and nor are we saying that any one scenario is more likely than another. At the moment, there's simply too much uncertainty to be able to do so. They are just scenarios that we think could possibly occur over the coming months, and that pension schemes may find helpful to consider in quantifying how the funding position could change. So what would those scenarios mean for our 3 example pension schemes? Let's first of all look at Pension Scheme 1, which saw its deficit increase from 20 million to 24 million over the last week. Under the 3 scenarios discussed, this scheme could see its deficit increase by a further 27 million under the very detrimental scenario, or indeed decrease by 10 million under the beneficial scenario. Whilst the deficit swings are great, the liability hedging controls the volatility to an extent. Pension Scheme 2, that doesn't have LDI, sees the deficit of 20 million varying between 14 million and 80 million pounds. Pension Scheme 3, which has hedged the lowest percentage of its liability, will be most impacted. It has already seen its deficit increase from £20 million to 33 million over the last week, and this could increase by a further eye-watering £78 million under the very detrimental scenarios, or decrease by 23 million under the beneficial scenario. Hugh will now look at what this means for pension schemes.
Now, this slide will hopefully be familiar to those of you who joined us for our previous webinar on integrated risk management. In that webinar, we discussed how the pensions regulator expects pension schemes to approach the topic of risk management in general. Looking at the very highest level, the regulator expects pension schemes to understand their exposure to risk and then to think through how that risk exposure compares with the risk appetite and the tolerance of the sponsor and trustees in the context of the sponsor's covenant. That comparison can then be used as a basis for deciding whether any action should be taken immediately or whether it's sufficient to develop contingency plans and monitor developments. Now, this framework will seem somewhat familiar. Brexit is uncharted territory, but the risks it poses are not fundamentally different from the other risks that pension schemes face. A decent starting position for trustees and sponsoring employers is to understand how they would fare under each of the 3 possible scenarios Ben's just described. The outcomes can then be compared against the risk tolerance and appetite of the trustees and sponsor. That gives a logical process for considering what, if any, action is appropriate at this stage. As an example, some may take a view that the fall in gilt yields is simply a recognition of a lower interest rate, lower growth future for us all now after Brexit. If so, the increase in the liabilities is here to stay, and we should be planning on how it can be financed. An alternative view may be that it is a relatively short-term reaction by investors desperate for a safe haven. In that case, the liability increase, which after all is the driver for the increase in the deficit, is simply a short-term blip which can just be allowed to wash in and then out of the system. Individuals will have their own views on the economics here, and many trustees will want to avoid knee-jerk reactions, rightfully so. But you do need the covenant to be able to buy time to do this. Now, risk tolerance and risk appetite is something which the trustees and sponsor may well have already considered, be that formally under the new integrated risk management or informally through pre-existing processes. But we should bear in mind that Brexit itself may have changed the tolerance and appetite, either because of changes in the covenant of the sponsor or because the sponsor would rather take less pension risk when faced with increased risks in other parts of the business. As ever, the best way to open this up is through open dialogue between the trustees and the sponsor. When judging whether Brexit has changed the strength of the covenant, trustees could look at several factors. As an example, many companies that import goods from the EU or export to the EU will face challenges and/or opportunities from exchange rate fluctuations, along with uncertainty around the nature of trade relationships going forwards. Banks have seen their share prices hit particularly hard, and there are questions over how financial institutions with European bases in the City of London are going to fare when Britain is outside the EU. So, understanding how the sponsor derives its revenue is likely to help in understanding how it may be affected by Brexit. Another sensitivity may be around the makeup of the workforce. There's been recent press coverage of how some companies that currently rely on employing substantial numbers of overseas workers could be affected by higher wage bills or quite simply a shortage of staff. Forgive me, many of these are rather open questions at the moment, and we shouldn't be expecting black and white answers. This in mind, we think it's sensible for trustees to be engaging with sponsors, asking how the companies themselves believe they will be affected and what plans the company has in place, or let's be fair, maybe developing. So let's look now at what action we think pension schemes and sponsoring employers should be taking. Pension schemes where evaluation is currently underway should be thinking about a number of points. First of all, does the covenant assessment, which is being used as the basis for the valuation approach, remain valid? This is a particular challenge for those valuations that are nearly completed, but we think it's essential that trustees at least consider the question. I'm not suggesting all valuations need to come to a shuddering halt, but finalising a valuation after the Brexit vote without even pausing for thought doesn't fit with trustee responsibilities. Similarly, before finalising a valuation that is currently underway, we believe trustees should check whether the changes in financial conditions mean that either the assumptions or the recovery plan needs to be revised. Again, it's possible that contribution rates aren't actually changed, but we believe it's prudent at the very least to check the figures. We also think it would help trustees and sponsoring employers to get a fuller picture if they see how the pension scheme deficit would develop under the three scenarios Ben described. For trustees, that information will help them check whether their risk exposure falls within their appetite and tolerance, while from the sponsor's perspective, that information should prove useful as part of wider business planning. We think that pension schemes which don't have a valuation currently underway should similarly look at the financial implications of Brexit on their scheme. Points we're looking at here are an understanding of where the scheme's financial position is today, seeing how it might evolve under the three scenarios that Ben identified, and then testing how that sits relative to the employer covenant and the approach to risk management that the trustees and sponsor have agreed.
And from an investment perspective, it's important to remember that pension schemes are long-term investors. As such, first and foremost, we recommend that trustees and sponsors don't rush to take any immediate action. Nonetheless, it is prudent to review any asset transitions that are due to take place soon to ensure that they remain appropriate and can be properly managed whilst volatility is high. Similarly, it is sensible to look at any trigger-based mechanisms that the scheme has in place to ensure that they remain appropriate, particularly if the triggers are likely to be met under a period of continued volatility. Once a scheme has protected itself from inadvertently taking potentially inappropriate action, we think two steps should be followed. Firstly, an assessment of whether the existing investment strategy remains suitable given the changes we've seen in financial conditions and potential changes in employer covenant. Remember here that as well as whatever views the trustees have, the sponsoring employer may prefer to adopt a different strategy in the short term if it is facing increased business risk. Secondly, it's undoubtedly true that continued volatility will present challenges and opportunities. Significant gains will be made by those pension schemes that react quickly, but doing so will require a nimble and robust governance structure, which should therefore be reviewed by the trustees.
So those are what we see as the main considerations for pension schemes and sponsors, but there are three further points I think that are worth touching on. Firstly, on regulations and legislation, some people have asked whether we might expect changes to any of the pensions legislation and regulations as a result of the vote. Now, it's true to say that much of the legislation affecting pension schemes ultimately has its roots in the EU, but it's equally fair to say that much of this has now been incorporated into UK legislation. Any changes would therefore require the political appetite in the UK to dispense with or indeed amend existing UK legislation, and of course it would only be possible if permitted under whatever trade deal is agreed with the EU as part of exit negotiations. We therefore wouldn't expect wholesale changes, particularly in the short term. Secondly, on the point of member communications, we're aware of some pension schemes that have received a significant number of calls from members over the last week asking about the security of their benefits and the implications of Brexit. A number of schemes have therefore put together an agreed response to any questions that do get raised, and indeed they're planning to include further commentary in upcoming newsletters. We think such an approach is sensible and would encourage other pension schemes to do so. And lastly, on company accounting, Ben and Hugh showed us earlier how funding deficits had increased over the past week due to changes in financial conditions. Now, it's not necessarily the case that company accounting deficits will also have increased, however. The gap between gilt yields and corporate bond yields has widened somewhat over the past week, which means actually that some schemes may have seen a reduction in their accounting deficit. Whether or not that's true for your pension scheme will largely depend on how the investment strategy has fared, but those with LDI, for example, may well have seen an improvement in their accounting deficit rather than a deterioration. So that's the end of the formal presentation. We've received a couple of questions as we've gone through, and we'll take those now. The first question that we've been sent is to do with investment strategy. So Ben, I'll pass this one to you if that's okay. And the question is, should we be trying to be opportunistic with our investments?
Okay, thanks, Paul. I think it's a tricky question to answer. In the short term, i.e. tactical opportunities, no. In the longer term, i.e. strategic opportunities, yes. There probably is an opportunity for schemes to be more opportunistic. To give you an example, thinking back to the credit crunch, there we saw an asset class called loans, senior secured loans in particular, that are very highly secure instruments fall in value substantially due to actions taken by lending banks, which created an opportunity for pension schemes to invest, to make significant sums of money in a very low-risk way. It's possible that that type of opportunity comes along again, and what we're really advocating is that trustees ensure that they have a governance structure that enables them to at least consider those sorts of opportunities because they might be beneficial. It's certainly not the case that they have to agree to invest in them, but being in a position where you can consider things reasonably promptly, and particularly if they're more strategic ideas rather than tactical ones, seems to us to make sense in this very volatile environment we're likely to see ourselves in.
Okay, thanks, Ben. We've also received a question that relates more to the liabilities, so I'll pass this one to Hugh. And this question is, should schemes be concerned about inflation increases given that pension increases in the scheme are capped?
Thank you. You need to be a little wary about that. It's true enough that there are caps that do apply to member benefits, but if we just separate out for a moment the types of cap which apply to a pension in payment and separately from the types of cap that apply to the increases from a member leaving service or when a scheme closed up until they retire. Taking that pension in payment first, the cap would typically be around 5%, at least for a substantial chunk of the pension. When inflation is running at 3%, that gives 2% a year headroom, which is a fair whack. That can cause a lot of damage, just 2%. Year on year. Now, that's the tighter cap. As far as members and the gap between them leaving and them retiring, that cap works on a cumulative basis, and we've had such low inflation over the last few years that effectively a burst of inflation now would run right the way through the scheme. So there is huge potential there for, say, a sudden burst of inflation to land straight on the company balance sheet.
Okay, thank you. We've had one other question on investment strategy, so again I shall pass this to Ben. And this question is, further volatility can be expected towards the end of 2016 as a result of the US presidential elections. How might this affect any responses to the Brexit vote now?
It seems to me that the potential US election is quite analogous to the Brexit vote in that there is the potential for a very significant impact or view expressed by the markets depending on which way the vote goes, but no one really knows either which way the vote is going to go or what the impact might be over the medium or longer term. So it seems to me that it's likely we'll see more volatility, as the question asked. It could be substantial, depending on whether the market starts to feel that one outcome is more likely than the other. And as we've seen with the Brexit vote, the market doesn't always get that right. In terms of whether pension schemes might do anything about it, well, it's probably the same kind of things that we would suggest you think about on the back of the Brexit vote. And what we've seen very clearly is that thinking about how much liability hedging you have in place and considering whether more is appropriate is sensible, and making sure your growth assets are diversified is sensible. And if the outcome of the US election was increased volatility and concerns over the future economic environment, thinking about those things in advance and taking action if you feel them necessary is probably sensible.
Okay, thanks, Ben. We've had one other question actually on investment strategy, and that is, following the recoveries in the FTSE, do you foresee investors coming back out of gilts? So again, Ben, could you give your view on that, please?
Yes, that's a really interesting question because we've seen equity markets fall substantially and then recover quickly, and we've seen gilt yields fall substantially and stay low, albeit the timescales are very short. And those two things seem a little inconsistent with each other in that immediate reaction, fear, flight to quality, on a little bit more consideration, maybe that was overdone, and a recovery in equity markets, but not the same sort of movement out of gilts. Does that mean that we'll see people sort of selling gilts and gilt yields going up? Well, it's absolutely possible. I think that what I would say is that the two movements seem out of line, and therefore maybe some sort of correction between the two is sensible, but which way that goes is very hard to say. Does it mean that there's going to be some sell-off in gilts and hence yields will rise, or does it mean that the bounce back in the equity markets is overdone and we could see further falls again once people think a little bit more about the uncertainty that's still out there? And I don't know the answer to those, but I would say that it's perfectly plausible that very low gilt yields, the sorts of levels we're seeing now, or indeed levels that are somewhat lower, could be here for a sustained period of time. So I wouldn't have confidence that gilt yields are going to rise, but it's absolutely possible.
Okay, thanks, Ben. That's all of the questions that we've been asked, so we'll now bring this webinar to a close. A recording of the webinar will be available on our website in the next couple of days, along with a Q&A document together with a copy of these slides, and we'll email you as and when those are available. If you would like to discuss any of the topics covered today in any more detail, please don't hesitate to contact either your usual affinity consultant or alternatively one of us, and we'd be delighted to discuss with you. So thank you all very much for joining. I hope it's been a good use of your time, and I'd be grateful if you just spend a few seconds as you leave to complete the exit feedback questionnaire. Thank you very much and have a good day.